Okay, next for the second subtopic, the discounting method of investment appraisal. Investment appraisal technique are payback period, accounting rate of return, net present value, internal rate of return, profitability index, and discounted payback period. They are primarily meant to appraise the performance of a new project. In the last subtopic, we have learned about the payback period. The payback period refers to the amount of time it takes to recover the cost of an investment. Simply put, the payback period is the length of time an investment reaches the break-even point. In this subtopic, we know that the payback period is one of the investment appraisal technique. So, if any one of you want to recap about the payback period, please refer to the last subtopic. Accounting rate of return method. What is accounting rate of return? Accounting rate of return is an accounting technique to measure profit expected from an investment. It expresses the net accounting profit arising from the investment as a percentage of the capital investment. It is also known as return on investment or return on capital. The formula of ARR, which is accounting rate of return, is as follows. ARR equal to bracket average annual profit after tax divided initial investment times 100. Example of ARR. XYZ Incorporation is looking to invest in some machinery to replace its current malfunctioning one. The new machine, which costs $420,000, would increase annual revenue by $200,000 and annual expense by $50,000. The machine is estimated to have a useful life of 12 years. First, we need to calculate the depreciation expense per year, which is the initial investment divided by years to get the depreciation expense. Second one, increase in average annual profit. The annual revenue will minus the sum of the annual expense and depreciation expense to get the increase in average annual profit. The initial investment is $450,000. Lastly, put the value into the formula, which is the ARR equal to the increase in average annual profit divided by initial investment times 100 to get the ARR. Net present value. Net present value is the most common method of investment appraisal. Net present value is the sum of discounted future cash inflow and outflow related to the project. Generally, the weighted average cost of capital, which is the WACC, is the discounting factor for future cash flows in net present value method. In essence, this method sums up the discounted net cash flow from the investment by the minimum required rate of return and deduct initial investment to give the net present value. The company should accept the project if the NPV is positive. So, this is the formula of the net present value, where the C1, C2 until Cn represent net cash inflow for year 1, 2 until N. K is the opportunity cost of capital, C0 is the initial investment, and N is the expected life of investment. The example of net present value. XYZ Incorporation is starting the project at cost of $100,000. The project will generate cash flow of $40,000, $50,000 and $50,000 in year 1, year 2 and year 3 respectively. Company's WACC is 10%. Find out NPV. From the question, we know that $100,000 is the C0, $40,000 is the C1, $50,000 is the C2, and $50,000 is the C3. And the K should be 10%. Substitute all the value into the formula and we can get the net present value of the project is 15,251 and 68 cents. Here, the net present value of the project is positive and therefore the project should be accepted. Next, the internal rate of return method. The internal rate of return, which is IRR, is a metric used in capital budgeting to estimate the profitability of potential investment. The internal rate of return is a discount rate that makes the net present value (NPV) of all cash flow from a particular project equal to zero. IRR calculation relies on the same formula as NPV does. IRR is sometimes referred to as economic rate of return or discounted cash flow rate of return. The use of internal refers to the omission of external factors such as the cost of capital or inflation from the calculation. The formula and calculation for IRR, where CF0 is the initial investment or outlay, CF1, CF2, CF3, CFN is the cash flow, and is the each period, and holding period, NPV, net present value, RRR, internal rate of return. To calculate IRR using the formula, one would set NPV equal to 0 and solve for the discount rate, which is the IRR. Because of the nature of the formula, however, IRR cannot be calculated analytically and must instead be calculated either through trial and error or using software program to calculate IRR. How to calculate IRR in Excel? There are two main ways to calculate IRR in Excel. First, using one of the three built-in IRR Excel formulas. The second one, breaking out the component cash flow and calculating each step individually, then using this calculation as input to an IRR formula as we detailed above. Since the IRR is the derivation, there is no easy way to break it out by hand.
In this tutorial, we will use Microsoft Excel to calculate the net present value and internal rate of return for a capital project. Given our example data highlighted, the first thing we need to do is calculate the net cash flows for each time period covered by the project's life. The net cash flow for any time period is simply the cash inflows for that time period minus the cash outflows for that time period. As you can see, for the initial investment, that's a negative number because the initial investment represents an initial cash outlay and there's no offsetting cash inflows. We can drag that formula to the other time periods to calculate the net cash flows for those time periods. Once we have the net cash flows for all of the periods in the project's life, we can calculate the net present value. To do so, we want to click in a free cell, type an equal sign, then the letters NPV for net present value. The first parameter is rate, which is going to be the discount rate given in the problem, 5% in this case. And then for the rest of the parameters, we want to highlight just the future cash flows for the project's life. Because of the way Excel handles the net present value function, we only want to highlight the future cash flows for this project, not the initial investment. Close that function, and that value represents the present value of the future cash flows in the project. We will note our initial investment below that, and then to find the net present value for this project, we subtract the initial investment from the present value of the future cash flows of the project. In this case, we have a net present value of $3,004.84. Next, we'll find the internal rate of return of the project. Again, click in a free cell, type an equal sign, and then the letters IRR for internal rate of return. And our values parameter in this case is going to be all of our cash flows, including our initial investment. Close that function and hit enter. And we can see that this project has an internal rate of return of 7%. To be more precise, click on that result, come up here to the increased decimal shortcut button, and click it twice. This project has an internal rate of return of 7.21%. Now remember, if our internal rate of return is greater than our discount rate, our net present value will be greater than 0. If our internal rate of return is less than our discount rate, our net present value will be less than 0. And if our internal rate of return is equal to our discount rate, our net present value will be exactly 0. So as you can see in our example, our internal rate of return of 7.21% was greater than our discount rate of 5%, meaning our net present value should be a positive number. And it is, so we're probably on the right track.
Next, discounted payback period method. The discounted payback period is a capital budgeting procedure used to determine the profitability of a project. A discounted payback period gives the number of years it takes to break even from undertaking the initial expenditure by discounting future cash flow and recognizing the time value of money. The metric is used to evaluate the feasibility and profitability of a given project. Example of how to use discounted payback period. Assume that company A has a project requiring an initial cash outlay of $3,000. The project is expected to return $1,000 each period for the next 5 periods, and the appropriate discount rate is 4%. The discounted payback period calculation begins with the minus $3,000 cash outlay in the starting period. The first period will experience a plus $1,000 cash inflow. Using the present value discount calculation, the figure is 1000 divided by 1.04 equal to 961.54. Thus, after the first period, the project still requires 3000 minus 961.54 equal to 2038.546 to break even. After this, discounted cash flow of 1000 divided by 1.04 square equal to 924.56 in period 2, and 1000 divided by 1.04 cube equal to 889 in period 3. The net project balance is 3000 minus 961.54 plus 924.56 plus 889 equal to 224.9. Therefore, after receipt of the fourth payment, which is discounted to the 854.8, the project will have a positive balance of 629.9. Therefore, the discounted payback period is sometimes during the fourth period. The difference between payback period and discounted payback period. The payback period is the amount of time for a project to break even in cash collections using nominal dollars. Alternatively, the discounted payback period reflects the amount of time necessary to break even in a project based not only on what cash flow occurs, but when they occur and the prevailing rate of return in the market. These two calculations, although similar, may not return the same result due to discounting of cash flow.